Good afternoon, ladies and gentlemen, and thank you very much for coming to listen. So, as the title describes, we're going to talk about a couple of films. I hope there are no film buffs here just expecting films. It's obviously a precursor, but we're going to go from a journey from The Magnificent Seven to look at the story of A Fistful of Dollars. Now, I was reminded when A Fistful of Dollars is set, it's about 1880. A Fistful of Dollars really did mean a lot of money, just to make that absolutely clear right from the outset. And hopefully it will lead you to the conclusion that UK equities could be good for your wealth over time. There's a usual investment risk warning here. In the context of the UK market, of course, it's been pretty disappointing for a while, so I'm going to warn you that shares can go up as well as down. We've also got a glossary. Many of these terms I'll be describing as we go through, so we'll flick over that. This is a much younger me. My credentials, though, I have managed the CT UK Capital and Income Investment Trust since March of 1997. We are an investor in UK equities, and as an investment trust, we ourselves are quoted on the UK market. We have a twin objective to grow our capital faster than the all-share index and to grow our dividend faster than the rate of inflation, and we've done that over long periods of time, so we're very proud to be an AIC dividend hero, having increased our dividend for 30 years in a row. And over that period, we're well ahead of the rate of inflation of growth as well. Investors very much like that we pay dividends quarterly and at quarter end, so I think that helps to make budgeting easy for people. As I mentioned, we ourselves are quoted as an investment trust. Sometimes within the industry, there is a gap between the value of the assets the investment trust owns, its asset value, and the share price. As an investment trust, we believe that those two should really be trading quite close together. We have a very liquid portfolio, and we have a record of making sure that the share price and the NAV trade close together. For long-term investors in investment trusts, we believe that's quite a powerful story. So in my brief time this morning, we'll touch on three matters: why diversification matters, why valuation matters, and importantly, why the UK market looks particularly good value at the moment. So we'll kick off with the Magnificent Seven. These, of course, the names at the bottom: Alphabet, Apple, Amazon, Meta, Microsoft, Nvidia, Tesla. These are companies whose share prices have performed fantastically. I'm not trying to take that away from them at all. But I will remind people, of course, that the future is inevitably uncertain. We can't make, with any great certainty, predictions about what will happen next year, let alone in 10 years' time. And it's quite possible that the valuations for these companies are discounting very, very positive outcomes across multi-year periods. I would caveat there's a lot of uncertainty about how these will perform. For those old enough, perhaps it's worth remembering with the onset of the TMT bubble in the late 90s, everyone was convinced the internet would be a big thing. That, of course, has proven to be spectacularly right, probably far in excess of anyone who could have predicted at the time. Everyone also thought that Cisco would be the company providing service for that. Its shares went to the moon because Cisco was always going to do very well, of course. That was the perception. In fact, that wasn't the case. So even if some of the broad concepts are right, working out which companies are going to be successful is another thing. Nokia handsets would be another point. Who has one now? And of course, by linking these seven companies together, their shares inevitably trade in a somewhat similar way. Stocks with similar themes get put into baskets, and these trade in a similar way. Someone investing in the M7 rather, will be buying shares in each of those. So these companies tend to rise and fall together. You don't really get much diversification. And of course, diversification is one of the basic tenets of successful investment. If you can't be certain about the future, don't put all your eggs in one basket. The Magnificent Seven are well over 30% now, I think, of the S&P 500, the main US index. So even if you're buying an S&P index investment, about 30% of your money or more is going into these companies. They may prove to be spectacularly successful, but you have to be aware of that. And just to put it in context, that market cap in excess of $13 trillion is multiples the size of the UK market. So Apple, I believe, is at or about the same size as the UK market. You could buy everything quoted on the UK market for the same price as Apple. By contrast, this shows the portfolio that I manage, the portfolio of CT UK Capital and Income. So as I said, we are UK investors. We invest primarily in UK companies, but we do have a bit of flexibility to go internationally as well. Starting with the donut on the left, the outside of the donut shows where those companies are quoted that we invest in. So you can see the majority of those are invested in the UK with a little bit of flexibility outside. But although they are UK companies, they don't operate solely in the UK. That's a rather obvious point, but this shows on the inner ring just how international our exposure is. And you can see that North America and Europe, for example, as two separate regions, but together, those regions in aggregate generate more revenue for our portfolio than the UK. So we are a truly international portfolio, albeit listed and investing in the UK. The bar chart on the right shows also how different we are to the index. I touched earlier on about the concentration risk, the Magnificent Seven being such a large part of the S&P 500. By contrast, when we invest in the UK market, we try and steer clear of some of the very largest companies. It's a rather obvious point, but trees don't grow to the skies. Companies can't become infinitely large, and smaller companies almost inevitably have greater growth potential. So the dark bars there show our portfolio, and the lighter blue bar shows the benchmark. And looking to the right-hand side of that chart, you can see that we have a good deal of our portfolio, over 40% of our portfolio invested in companies with a market cap of between 0 and 5 billion, compared to the index of less than 20. So we've got twice the exposure in those smaller and medium-sized companies which have greater growth potential. That's diversification. Valuation. Valuation is vitally important. If you think perhaps of buying a bond, it becomes very obvious. The higher the price you pay for a bond, which has known cash flows over time, the more you pay for that, the lower your return will be as a percentage. That's the theory. It's very straightforward. Slightly unusually, the theory and the practice in this actually do matter. Here, switch to thinking about equities. Going back to that uncertain world, you can buy a share, but you don't know what's around the corner, let alone what's there in 10 years' time. And in practice, it's pretty clear also that higher starting valuations, thinking mentally again of the Magnificent Seven, higher starting valuations nearly always lead to lower returns. This is slightly less true for individual companies, and I will think that's a very important caveat because individual companies can and do have fantastic success over time. So Apple would be a prime example of that. It's been a great business, and Microsoft for many, many years. So individual companies can perform exceptionally well, perhaps almost despite their starting valuation, but it's much less true for indices. And if you think why that might be, an index is inevitably made up of hundreds of different companies. Not all of them can perform well if they start with a high starting valuation. The long-term data, which we'll see in a moment, is very clear on this. But I'll touch on the UK market here just to show how the valuations are so very different to international ones. There's a lot going on in this chart. Let's start with the vertical on the left. That shows the valuation parameters for the US S&P 500 index going back over a long period of time. The grey box in the middle tracks how the PE valuation for that index has moved over time. So about half the time, it's been between a valuation of 14 times and perhaps 17 times. The dot in the middle shows the median. The wider bars show where the valuations for that index have been across a longer period of time. So only 10% of the time has it been lower than that, and 10% of the time it's been higher. The orange dot, you can see at about 18 times, shows that the S&P 500 is trading quite a long way above its normal historic, at the higher ends of its historic range. The next vertical you can see is the European Eurostoxx index. You can see that's nearly always been a good deal cheaper than the American index. And within that, the orange dot is well below the average. But it's the next two, the FTSE 100 and the FTSE 250 index, both constituent parts, of course, of the UK, which really stand out. And here you can see that the orange dot for the FTSE 100 shows that the index has really not traded much more cheaply, perhaps 25% of the time, but it's well towards the bottom end of its range. But for the FTSE 250, that's the group of companies below the FTSE 100, mid-cap stocks, they're often called, that current valuation point is a long way below that median range and indicates, all other things being equal, where value lies. Right towards the...
What's the time period?
So this data goes back a long way. I can't remember off the top of my head. I think it goes back to the Second World War, so it's a long stream of data. And right to the right-hand side, we see the equally weighted S&P 500. It's taking out that effect of the Magnificent Seven being so large. And you can see the American market perhaps does not look as expensive as you might think if you take out those very largest companies. Putting these, again, into a long-term time series, you can see, as I suggested earlier, that valuations do matter. That the higher the valuation you pay, going to the right-hand side of these charts, the lower your future return. That's the vertical axis. The line of best fit has been plotted on there as well. These are data points looking back over multiple years for these indices. The one on the left, the US starting valuation, we're at about a 20 times PE at the moment. Looking at that line of best fit would suggest in future, for the next 10 years, you would get on average a return of about 8% per annum. In fact, that's not too bad at all. But by contrast, the UK, the chart on the right, shows with our current starting PE multiple of about 10 times, putting that on the line of best fit would get you to a compound annual return across a decade of about 13%. That would turn your money, £1,000, into about £3,500 over a decade, just to show you the power of compounding. Why is this? Well, it's been quite widely reported that interest in UK domestic equities has fallen quite considerably. And this chart, using the green line, shows how retail interest has fallen from about 8% of the market to roughly 4%. So UK domestic investors have lost interest in their own market, despite the fact it's fallen. That's one of the reasons why the government and regulators are starting to step up. They've recognized this is a problem. The BRISA, as announced earlier this week, is an attempt to start to address that. And pension funds also are going to be asked why they don't invest as much in the UK market as they could do, and what they're going to do about it. Here we look at equity flows, money flowing into equity markets. And you can see there has perhaps been a little bit of a pickup in recent months. Certainly there was a long period of time throughout 2022 when money was flowing steadily out of equities. That, of course, creates a drip effect, which makes it quite difficult for equities to perform if everyone's selling. This doesn't extend to UK equities, I hasten to add, but of course, when that turns, that will be quite a powerful point. If equity investors, domestic investors, aren't buying equities, then who is? And this chart goes some way to show that companies have become big buyers of their own shares, and they're starting to recognize that buying their own shares is a very powerful thing in driving their own performance. So those companies which buy back their own shares in the biggest way are performing most strongly. Over here, we track over 20 years what's happened to the UK equity market with flows in and out. So the dark green bars at the top show equity issuance, so whether that's IPOs or placings or rights issues, that's companies issuing new equity. The lighter green underneath the line is effectively share buybacks or takeovers. And you can see that in recent years, since the recovery from a pandemic, companies have been really buying back their own shares in quite an aggressive way. And that is starting to have an effect on the market. Benjamin Graham is well known as the mentor of Warren Buffett, who I'm sure will need no introduction to anyone here. And he pointed out that in the short run, the market is a voting machine. It responds to these flows, the pluses and minuses of whether people are buying shares. But in the long run, it's much more important to track what's happening to the cash that's coming out of companies, dividends and earnings. You put that together with the fact that valuations have historically, the current point of valuations suggests that returns will be high, and you can see that these, not exactly forecasts, but statistical analysis would suggest that future returns could well be quite attractive. They link very closely to the data that I showed earlier. And you can see that taking the bar on the far right-hand side, looking over 10 years, that would suggest that the market, if you're investing in FTSE 250 or small cap stocks, will give you returns of in excess of 10%. No guarantees, of course. This is just based on statistical analysis, but it's an attractive rate of return driven by that very low starting point. So, to wind up, and for the film buffs in the audience, what happened in these films? Well, of the Magnificent Seven, only 3 of them survived the film. 4 of them died. Whereas our hero, Clint Eastwood, the man with no name, having made a fistful of dollars in the first film, he went on to make a few dollars more. So, thank you very much for your attendance today.